All right, let's take a look at how the currency markets are reacting to the ECB decision. Again, you're taking a look at the euro versus the US dollar move here to the upside following European Central Bank's decision to cut interest rates. It's the first time we've seen the ECB cut rates since 2019. And remember, they lowered it from that record high of 4%. So here to talk about that and more, we want to bring in Mark McCormick. He's TD Bank, a global head of FX and emerging market strategy. It's great to see you again. So first, just talk to me about some of the movement that we're seeing right now within the FX market and whether or not some of the trends that we're seeing today, you see those trends sticking.
Yeah, I think a key piece here is that, kind of markets were looking for the ECB to cut rates. That was, fully priced in. I think a big piece is kind of like what they do next. A lot of people have been looking for central banks to deliver some form of forward guidance, kind of give them some expectations of where they think things could go in the future. But in the environment that we're in, central banks are what you would call data dependent. So essentially data dependency kind of overtakes the ability for them to provide any credible forward guidance. So I think part of the reaction here is the ECB can't really pre-commit till July, which is the next meeting. So markets were kind of hoping maybe they could give a little nudge that they can move again in July. But now the next meeting that's kind of live is September. So there's a lot of guessing now. Will inflation come in as expected? Will it continue to fall? Will it come in higher? So now we're back to the guessing game. And, I guess you could say the markets will qualify this as a bit of a hawkish cut without the commitment of moving in July.
Well, it's interesting because, Mark, we were just speaking with another guest about how in the States, the higher for longer environment has a very different impact than it might globally. But we are still seeing this kind of historic divergence in the G10 central banks. Is that kind of something that we should be considering as a potential shock? Or given what I just said about how higher for longer has a different meaning in the U.S., does that make sense to you that we're seeing this divergence?
Absolutely. I think there's the challenging part about the currency markets is it's always kind of multidimensional. It's like it's very well known for kind of markets kind of looking at one thing and then having to change their vision, and correlations constantly flip in the FX market, which makes it very challenging to stick with an idea for too long as the market evolves. So I think a big piece that you need to think about here is really the relationships between economic growth and inflation. And one of the things is the FX market's kind of only been focused on one or the other for a little period of time. And one of the things that strikes at the heart of G10 central bank divergence is inflation. And so the underlying indicators that we track, things that we run in our models, things that we run in portfolios to track currencies, we look at inflation strength. The strength of inflation data in the US is just much stronger than anyone else in the G10. The interesting part is that the growth story is now converging, where the US is slowing, Europe is recovering, other parts of the world are recovering, and the market can't really make its mind up whether or not it wants to sell the dollar on the converging growth story or whether or not it wants to buy the dollar on the diverging inflation story. Our view here is if you kind of take this, the mindset that we have, there's just very little room for error for the Fed. The markets are only 50-50 for September. And if we get one bad, which is high inflation surprise in the US, that can challenge the disinflation narrative. And that is what would exacerbate the G10 central bank divergence, which is we already saw from the Bank of Canada yesterday. They cut. They look like they can move in July. Again, ECB hasn't pre-committed, but they could basically cut in September. So we could basically get to the fall. And we've seen many G10 central banks cut: SMB, BRICS Bank, Bank of Canada, ECB, even the Bank of England, and we have not seen a move from the Fed. And this is a very live possibility, which is something that would challenge this Goldilocks environment where we're in, where FX volatility is very low.
Well, let's talk about the election a little bit. You mentioned in your note that markets are not priced for tariffs, but as you know very well, the tariffs are going to look very different if we get President Trump come November. How much does that impact your outlook on the US dollar, the potential for President Trump coming back into office?
I think it has a big impact because FX has to consume this information more readily than anyone else, any other market. So if you think about just what happened over the past week, there's tons of volatility in India, there's tons of volatility in Mexico, tons of volatility in South Africa, because we are getting unexpected surprises that are coming through on the geopolitical, on the political front. So if you bring it to the US, just running off of the concept that inflation in the US is going to be above target. So whether or not the Fed can cut in September, whether or not they can even cut this year, they are going to be cutting in an environment where inflation is above target. which is going to be interesting for the narrative. And at the exact same time, they're coming through. And even if we don't see the Fed cut, we're going to be in an environment where inflation is very elevated. So the concept of Trump winning is challenging, just given the mandates or even the rhetoric around fiscal stimulus, on corporate tax cuts, on tariffs. All of these things are inflationary. So if you're running at above target inflation and the central bank is trying to get less restrictive and trying to cut rates, and you have a macro policy coming from a presidential candidate that is inflationary, the markets have to recalibrate and have to rethink about what themes and what things are going to be driving at the moment. So I think a big piece here is that, again, we're in a Goldilocks environment where it feels as if macro volatility, FX volatility is very low. The dollar's been weakened quite significantly through April and May. And so if the market increases the probability that Trump to win, they have to realize the first order effect of these policies coming into play, which is pricing in the risk premium and having the strong dollar. And that's also what brings us back into the G10 divergence in terms of the central banks, because that would be higher longer for the Fed, while these other central banks are kind of moving along and cutting.
Mark, great insights. I'm going to assume that the math on the chalkboard behind you contributed a little bit to those. Really appreciate you joining us. We're excited to have you back again soon. Thank you so much. That was Mark McCormick.
Thanks.
He is TD Bank's Global Head of FX and EM Strategy.